Let's start by looking at the tax formula for corporate taxpayers. We start with total income from whatever source. But this income is going to include some income that is not taxable. So we're going to exclude that income, the non-taxable income, to arrive at gross income. Then remember all of those congressionally allowed deductions, which we subtract from gross income to arrive at taxable income. Now we're going to use either a formula or look it up in a tax table to come up with a gross tax liability. Credits are legislatively allowable items that reduce tax dollar for dollar. I use that to come down to a net tax liability, and then prepayments are usually in the form of estimated taxes that are paid throughout the year in anticipation of a tax liability at the end of the year. The final number is the tax due if prepayments are less than the liability, or a refund if prepayments were in excess of the net tax liability. The tax formula for individual taxpayers is going to look a lot like the corporate taxpayers. We have total income and exclusions from income that bring us down to gross income. But here's where the big difference lies. We have deductions for AGI. AGI stands for adjusted gross income. And we break up our deductions into two big pieces. Deductions for AGI, which bring us down to our adjusted gross income, and then deductions from AGI. And that brings us down to taxable income, and the rest is the same. So remember, these are the big differences between the corporate tax formula and the individual tax formula. Corporations just have deductions to get down to taxable income. Individuals have gross income less deductions for AGI, which brings us to an AGI, and then deductions from AGI. Adjusted gross income is an important number that's used repeatedly in the federal tax system and is frequently the number that state taxes begin with.